Welcome to Stock Talk with Nico Kritikos. Today we're going to be going through Caterpillar, ticker CAT. This is a stock that is pretty much break even over the past couple of years, the past year, but we've seen a low of $188 in October and a high of $244 last summer. Right now, the stock is at $196 or a $106 billion market cap. And we're going to do some analysis to see if this stock is trading at a healthy valuation and if the company has healthy fundamentals. So first up, we have, is the stock down or oversold? I put yes. It's not down a lot, but it's down a good enough amount from its highs to where it wouldn't be a bad time to buy off of that metric. But if we keep moving, we can see revenue increase. So I put no on this one because if you look at their revenue for the past couple of years, it actually has not been increasing the way you might think it would be. So the past year, revenues were actually up. If we look here, it says revenues or fourth quarter 2021 revenue was up 23%, full year sales up 22%, right? But that's coming off of the Corona quarter, the Corona year of 2020. So that's a little bit of a different story. But if you look at the previous years, you can see that the revenue has gone from 54 billion, 53, then 41, and then 50 now, and it's still not back to where it was in these 2 years. So that's not an ideal situation. If we look at net income, though, we have a yes. I put a yes here because we see 6.1, 6, 3, and now it's 6.5, which is higher than these previous years. So there's some improvement there. 2021 was a much better year than 2020 for them. But that'll get a yes. And then we have price to sales and price to earnings for this year. And right now, this company is trading at a price to sales of 2.1. Let's see, this is a price to sales of 2.1, forward PE of 16. As you can see, this 16 number is pretty much lower than where it's traded at during the past year or two. And price to sales is pretty much cheaper than where it's been. And if we look at how much this company is expected to grow as far as EPS and revenue, this company is going to do what, 14% growth this year and then 10% the following year. Price to sales of 2 actually makes that look super undervalued. And same thing with EPS. EPS is going to go from 10.8 or 9.5 to 10.8 to 12.8. That's significant EPS growth there. So that price to earnings is cheap. Next up, we have, is the company innovative? Do they have a moat? I put yes. They are the leader of what they do. They're the biggest company in the business of, selling these. They have several different brands and several different businesses, but their main thing is just building out these construction machines, and they also have locomotive trains, all these different things. Okay, so and also the market share is huge. They own, who knows what the market share is, but it's probably at least 40-50%. And then finally, I put they're also in the Dow 30, which there's only 30 stocks that can be in the Dow, and Caterpillar is one of them. So that's going to give them an extra boost year after year to their stock price. Is it a growing industry? Yes. Even though revenue, well, I guess revenue was up. It was up this past year, but it wasn't up the years prior. So, but the bottom line is the industry is still growing. They're just, maybe they have some catching up to do. The revenue's probably been hurt still by COVID. So once we get over that completely, revenue should, get back over $55 billion. But I still would consider that a yes. Return on invested capital. Yes. If we look at return on invested capital, we will find a 11.8%. Not too bad, right? So that'll work. And if you wanted to calculate this yourself, sometimes that website gives the numbers aren't entirely accurate. So if you wanted to calculate it yourself, what we do is we take the net income for this past quarter, right? So we got what, net income of $2.1 billion, right? 2.1 billion. And then we figure out how much cash, how much capital did it take for them to earn that. So as of this past quarter, they have what, around 9.2. So we would go, we'd go what, 2.1 divided by 9.2, and that gives us 23%. So that's actually a 23% return on capital. If you do it based off that, that's 9.3 billion in cash. And let's see. Yeah, 9.3 billion in cash off of 23% of that would be, should be this number, 2.1 billion. Yeah. So that's right. So that's really good, actually. That's a super high number. But see, so this website is a little bit inaccurate. They need to update that. Next up, healthy margins. Yes, I believe one of these websites was showing, see, so profitability, profit per share, EPS was 11.83 for this past year, versus or adjusted profit of $10.81. And then this document also shows you in all the different areas of the world which retail sales are going up the most. So in Asia, it looks like it was down 8% this past quarter, but on average, it's around this 7%. You see Latin America up 15%, up the whole world up 5%. So most of these categories, though, are increasing and going up. So that is definitely a good sign. You can see power generation, industrial, transportation, oil and gas, all of them are up. So that's a good sign. Next up, we have healthy cash flow. If you look at the cash flow, it's still, this is a big, solid, reliable company. So they should have healthy cash flow. And here we see operating cash flow going from 6.5 all the way up to 7.2 over the past couple of years. And cash position has been increasing for the most part. So that's also good. And so that's going to get a check. Then we have diverse revenue streams. How I said earlier, they have multiple different, they have like at least, I want to say 15 different brands that creates these different products, right? They also have, they rent out some of these machines too. So there's also money coming in from that. So you can see you have energy and transportation. They have all these different, see, here's all the different products they make, right? Asphalt pavers, different trucks, different tractors, all this stuff. Then we look at the balance sheet. Balance sheet is solid. Assets versus liabilities look good. Very high equity number relative to the market cap. If we want to see, so this company trades at a market cap of what, a little over 100 billion, and the equity, if it'll load, the equity is 16 billion. So it's around 16%. That's pretty good. That's pretty good. Then is the equity increasing? Yes. You can see the past couple of years, it's gone from 14 to 16.5. And do they have a strong share buyback program? Looks like they, right here, it says returned $5 billion to shareholders this past year through dividends and share repurchases. If we look at this website, I'll see, but yeah, okay, so that's good. So they got 1% less 1% fewer shares on the market. That's a good sign. And then as well as the dividend of 2.2%, payout ratio of 36%. That's good. That means they're only paying out about a third of their earnings in dividends. So they could honestly probably raise that to a 3 or 4% dividend. Then big money or insiders interested. If we look here, we can see, so look at Bill Gates owns $2 billion. And the thing though here is, if you look at, there's much more, at least for this past quarter, there's been much more selling pressure than buying pressure. Here's the selling pressure. 6 million shares sold from this fund, 2.4 sold from this, 1.8 million sold from this, versus the funds buying it. The top fund is 1.3 million shares bought, and then the rest of these are all under a million. So the past couple of months has seen much higher selling pressure than buying pressure. And then finally, is it founder led? Do they have good management? the founders is not the current CEO, but the management looks good. You know, they've done a good job growing the company. A good metric to base the management off of is the return on invested capital. And with that return on invested capital of 23%, that's a good sign there. And I think if you look up all the executives at the company, you can see that they've worked at, a lot of them have so much experience at other bigger companies. So that's also a good track record to have. But yeah, altogether we have what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So it almost hit all of them. So this is going to get 17 out of 18 score. And I'm currently not interested in buying this at the moment. I still think the stock price can seem kind of high, because I could picture it coming back down to somewhere around this $150 mark if the economy was to, you know, slow down a little bit. But I don't know. I would say it's still a safe company to be invested into. So I would say it's a good one to have, but I would say it could definitely, I wouldn't buy it yet at $196. I would wait till around 170 or lower. But that is all for today. Thank you for watching, and I will see you in the next video.